Let me get started. Thank you very much for having me in this great program. I'm Shumia Ouyang, a PhD candidate at Princeton, and I'm actually on the job market this year. This is my job market paper. So all the comments would be greatly appreciated, and I'm also quite looking forward to Andrew's discussion. This paper is about cashless payment and financial inclusion. So firstly, let me introduce the background about this financial inclusion challenge. It's widely known that it's quite hard to provide financial services to the underprivileged individuals, and extending credit access to them is even harder. But recently, we see a boom in the big tech credit in a lot of countries, and it's overtaking fintech credit. And it's likely to increase the credit provision to those who are previously underserved. At the same time, we also see a rise of the mobile cashless payment, especially those provided by big tech firms. It naturally combines important technological advancements such as data, models, and accessibility, and so on. And it has also accelerated the shift from cash to cashless economy in a lot of places. And my discussant, Andrew, has a very nice paper about microcredit as a pathway to the commercial banks. And actually, we can naturally ask whether this payment can be a pathway to the more credit and also can be a solution for the financial inclusion challenge. So here's the research question. Has cashless payment facilitated lending to the traditionally underserved? If so, then how? Although we see the joint rise of the digital payment and the digital credit, it's kind of hard to establish causal relationship between the two. Why? Because it requires an exogenous shock and cashless payment activity, which is hard to find. And also it requires detailed individual level data on payment, credit, and so on. So to solve these empirical challenges, I try to combine a natural experiment with rich administrative data for MoneyPay. And I've actually spent more than 2 years physically in Alibaba just to analyze the data. And here are the main findings. First, we find the cashless payment flow facilitates credit provision and credit take-up. For the credit provision, we can see there's a large increase on both the extensive margin and the intensive margin with an exogenous increase in the in-person payment activity. So why can this credit provision happen? I show that it's because the big tech takes advantage of the information in the payment flow. And it is beyond the information in the credit usage or credit repayment. It is also beyond the enforcement power that comes from the assets and the management. And in my paper, I also have also estimate a simple model to quantify the information value of the payment data. It shows that with the availability of the payment data, the credit line and both the consumer welfare and the lender profit is likely to increase. But due to the time limit in this talk, I will mainly focus on the empirical part. And lastly, I show that it's the financially underserved who really benefit more from this digital payment adoption and credit provision. We see stronger effects on those who are less educated and older. So let me introduce two phenomena that are quite related to the research. One is the boom of the cashless payment market. So here, I plot the US card payment transaction volume over its GDP, which is in blue, and China's mobile payment transaction volume over its GDP, which is in red. We can see the patterns are quite different. For the US card payments, the transaction volume was about 30% of its GDP all over the time, and it's quite stable and mature. But for China's mobile payment in 2012, it was only about 4% of its GDP. But as of the end of 2018, it has become about 30% of its GDP. So everything it increases like so fast. And actually, it's not something just for China. If we look at the other countries, we can see that it's also happening for many other countries. And also at the same time, we also see a rise of the big tech credit. So let me briefly introduce Alipay and the Huabei credit line, the two objects that I'm going to study in this research. Alipay is the largest mobile wallet in China with more than 1 billion active users, and the Huabei credit line is a virtual credit card provided by Alipay to its users, and it now has become the largest consumer finance product in China. In a representative sample of Alipay users, I find that about 72% of them have access to the Huabei credit line. So just from this number, we know it's quite inclusive, and people do use it a lot. So among those with Huabei access, 95% of them have used the credit with an average monthly usage of about $80, which is about 20% of the average disposable income in China. And even among those who do not have a credit card on file, about 64% of them have access to the Huabei credit line. So it's likely increases some credit to those who are not well served by the traditional banks. And in terms of the data, I get the representative random sample from the whole population of Alipay users, and it's individual level panel data at the monthly frequency, and it contains detailed information on not only their personal characteristics, but also their activities like payment, credit, investment, and so on. The sample period covers about 41 months from May 2017 to September 2020, during which period both mobile payment and bike sharing industries develop quite fast. Okay, so you might be wondering why am I mentioning like the bike sharing industries? Because it's crucial for the identification strategy. So here I just shows the solution, a flowchart about my solution for the identification strategy. So basically, I use the placement of Alipay bundled shared bikes as an instrument for the in-person Alipay payment. So for the Alipay bundled shared bikes, is the bikes that you can directly unlock with the scan function of the Alipay. And using exactly the same scan function, you can also scan the QR code of the local merchant and make some in-person payments. So that's why we expect to see some nudge effect there. And next, I will show some direct evidence about this nudge effect with the event study framework. So the event we're looking at is the bike adoption, and the target variable is the 1 plus X transformed in-person non-bike payment flow. So it has already excluded the bike-related usage fees to avoid the mechanical effect. And we see that right after the bike adoption, people start to heavily increase their in-person non-bike payment flow, and this effect is large and also quite persistent. So we do see this nudge effect. So next, I will show some evidence to show the validity of the instrument. First, I will talk about the relevance condition and then the exclusion restriction condition. For the relevance condition, we expect to see a strong relationship between the bike placement and the in-person payment flow of the ones who live in the same city. And that's what we see in column 1. And I guess what's more interesting is in column 2, where we will separate the Alipay users into the bike users and the non-bike users. We're only seeing the bike placement's effect on the in-person payment flow of those bike users, but not the non-bike users. Well, it actually makes sense. So imagine you're a person who do not know how to ride a bike. Then, no matter how many bikes are placed around you, your behavior might just not change. So in that sense, this also supports the previous nudge story. And column 3 is just another robustness test, and it basically shows that this bike placement's effect happens after the bike adoption. And now let me talk about the exclusion restriction. So column 1 just shows the reduced form effect of this bike placement on the credit provision. And in column 2, when we separate the Alipay users into the bike users and the non-bike users, we're only seeing the effect of the bike placement on the bike users, but not on the others. So one common worry about the exclusion restriction is that there could potentially be some, for example, a local growth potential or local infrastructure plan that can be correlated with everything. So this column 2 can help us to rule out these alternative stories, because if that's the case, then the bike placement is supposedly to correlated with like these common factors will be supposedly to correlated with both the back placement and the credit provision at the same time for all the people. But here we're only seeing that for the back users, which can help us to show that, well, it's just this nudge effect, and it goes through with this IV channel. And next, we just use the back placement as an instrument for the in-person payment flow and to see the IV analysis. So in panel A, we report the second stage result. In panel B, we report the first stage result. In panel C, we report the OLS regressions. And in different columns, we just look at the credit provision or in-person payment flow on different margins. But all these columns give us quite a consistent message. So in panel B, it shows that the back placement can be quite strong instrument for the in-person payment flow. And in panel A, it shows that when there was some exogenous increase in the in-person payment flow, people tend to have an increase in the credit provision on both the extensive margin and the intensive margin. And we see this credit provision happen, and we might be wondering why it can happen. So the lender can get more information about these borrowers if they have an increase in their payment flow. So the information can come from the transaction data itself. It can also come from the credit usage or credit repayment. So to kind of separate these two, we categorize the payment flow into the non-credit payment flow and the credit payment flow. And for the non-credit payment flow, it would have nothing to do with the credit usage or credit repayment, because these are the money that people pay from their own pocket. And for the credit payment flow, it's just the rest. And even if we only focus on the non-credit payment flow, we still see that it has large and positive effect on the credit provision. So in that sense, it tells us that the transaction data itself can already be quite useful in the credit evaluation. And we might also be worried about the enforcement channel. For example, if one person uses the digital wallet every day, then he might be worried that if she do not repay on time, then the platform might potentially freeze the account or forbid the user from accessing the assets under management. So we further add the assets under management as a proxy for the collateral and add it as a control. But still, we see that the in-person payment flow has quite a large effect on the credit provision, and the magnitude doesn't change very much. So this slide basically shows that the transaction data itself can be already quite powerful, and it's kind of different from the credit usage and credit repayment information that we usually have access to in the credit bureau. And the last part is about the financial inclusion, about the heterogeneous effect. So firstly, I use this table to confirm a traditional view in China that is less educated and the older who tend to be the financially underserved. And here we see that they tend to have lower financial service usage and also lower financial literacy. And in my paper, I actually show that the model predicts that both directions can happen. Like more information to the lender can lead to financial inclusion. It can also lead to credit reduction to the financially underserved. And let's look into the data and see what is the case in the data. So we just separate the users into the less educated and the more educated. And in columns 1 and 3, we focus on the less educated. And in columns 2 and 4, we focus on more educated. Although in panel B, we see that the first stage result is pretty strong for both groups. In panel A, we're only seeing the strong effect of the in-person payment on the credit provision for the less educated, but not the more educated. So in that sense, it supports the financial inclusion story. Okay, so let me conclude here. In a next review by Berg, Foster, and Puri, they raises two important open questions. One is the information from payment flows a causal factor behind the credit expansion? And the second is, does it benefit customers previously underserved by the traditional financial institutions? And my paper tried to use unique data and a new identification strategy to answer yes to both questions. And this is also the first paper showing that the payment information fuels the big tech credit to household. It also has some policy implications, showing that the mobile payment can potentially provide some new opportunities for sustainable and inclusive finance. Okay, thank you.
Thanks a lot, Shumiao. It was very well structured, very clear. So now to discuss your paper, I would like to welcome Andre Silva. Andre works, Andre, can you hear me? Let me see whether Andre is around.
I am. I was just muted. Sorry.
Oh, okay. Excellent. Andre.
Andre
works at the Federal Reserve Board, where he's senior economist with the Banking and Financial Analysis section of the Monetary Affairs Division. And Andre, the floor is yours. 10 minutes, please.
Thank you. All right. First of all, let me thank the organizers for inviting me to discuss this excellent paper. Let me jump straight in. So there's this major innovation in the last decade, which is the rapid growth of both fintech and also big tech credit. And as you can see from this chart in the middle, actually big tech credit has surpassed fintech credit in many countries, especially in Asia, so China, Japan, and South Korea, as well as in sub-Saharan Africa, in countries such as Kenya. And one of the great advantages of these alternative forms of credit is the use of non-traditional data, be it payment flows or mobile money, to develop alternative credit scores. So this has great potential because it allows you to extend credit to previously underserved individuals that do not have collateral or traditional credit scores. And this is great because 24% of all adults worldwide are still unbanked, according to the latest fintech survey that just came out. But unbanked adults have a mobile phone, so there is a lot of potential here to be tapped. So in this paper, Shumiao basically asks whether the adoption of cashless payment technologies can improve access to credit, particularly among the underserved population. And the setting, as is just described, is Alipay in China, and in particular, the Huawei credit line. So this is a virtual credit card product that is provided by Alipay and is the largest consumer finance product in China. In terms of identification, this will be an IV exploiting the staggered placement of Alipay bundled shared bikes across different Chinese cities. And finally, in terms of data, you will use around 40,000 randomly selected Alipay users from 2017 to 2020. All right, in terms of main results, very quickly through this, it's a very positive paper. So the paper finds that the adoption of cashless payments does improve access to credit, both at the intensive and extensive margins. The paper also finds that this effect is concentrated mainly on the less educated and older population, so among the underserved population. And in the structural model that Shumiao did not have time to go through, he also shows that relative to a counterfactual scenario where the lender does not observe this type of payment data, the availability of such data increases both credit line size and usage, consumer welfare, and lender profits. All right. In terms of general assessment, so this is an excellent paper on a very, very policy relevant topic, at least in my view. The identification is very convincing and it has a battery of tests to validate it. Actually, it's a very difficult paper to discuss because every time I thought it was something missing and I took note, I found it done later on in the paper and put somewhere in the appendix. So I have still a few comments, not exactly on what's in the paper right now. I will have a small note on the IV. But my comments will be more on what I think it's missing from the paper. And let's start with my first comment on whether this is all too much of a good thing. So digital credits can be very important in improving financial access. That has been shown to be the case in Africa, for instance. But the question here is whether such a rapid expansion of digital credit is at all sustainable. And there are reasons to be concerned. So this report from CJAP that is hosted at the World Bank in 2018 did a study in Tanzania and Kenya, and the figures here are staggering. So they show that in both Tanzania and Kenya, the rates of late repayments of digital loans are around 50%, and the rates of defaults are above 30% in Tanzania and 12% in Kenya. And there is a recent paper that focuses on digital loans in Malawi. It shows that the results are more or less the same. So they show that the majority of borrowers, of digital borrowers, fail to repay their loans on time and incur high late repayment fees. So beyond the financial stability issues that this might entail, so what's the problem here? The problem is that with a well-functioning credit information system, these digital borrowers with late payments or defaults on their digital loans could simply be unable to access traditional commercial bank loans that tend to be larger, longer maturity, and cheaper. And why is that? Because they would be flagged in the credit register as late or non-payers. And actually, Ant Group, so Alipay, started providing credit information of Huawei very recently in 2021. And the sister product of Huawei, that is called Jiabei, that is for larger consumer loans, started providing information to the credit register since its inception in 2015. So my suggestion here to Shumya would be to analyze late repayments and defaults more explicitly in the paper, if possible, of course. I understand the data limitations, but I think this would be a very important issue to analyze, or at least, if this data is not available at all, to at least discuss these issues, because from a policy perspective, it's crucial to provide a balanced views of the benefits and costs of digital lending. And it's important to note that defaults are featured in the structural model, but this is a very different exercise. And these results on defaults are in my view, downplayed throughout the paper. So we cannot find this mentioned either in the abstract or the introduction or the conclusion. We need really to dig deep to find that there is something being done on defaults in the model. And it's important because the model still shows that the default rates increased in the transition to the digital money user case by 13%. Just a quick note still on this topic, but on the overspending results. So there is this result that there is a big increase in spending, but then there is not so much a long-term reversal. And Shumyao interprets these results as suggesting that the overspending issue might not be mild, by me mild in this setting. I find this a difficult statement to be made without examining ex post performance of digital loans. So we don't know if someone is overspending or not, because we don't know if this person is able to pay the loan on time later on or not. Right, so on the second comment that I want to raise, again, outside the scope of the paper, but that could be integrated in this or a spin-off paper, is the interaction between digital and traditional bank credit. So the size of these Alipay granted credit lines is relatively small. They can even be interpreted as microcredit. The good thing is that these small loans, being digital credit or traditional microcredit, can serve as an entry point to the formal banking sector. So this has been shown in the case of China in the context of SMEs by Thorsten Beck and co-authors, and as well as in the context of traditional microcredit in sub-Saharan Africa, in this case in Rwanda. And why is that? Why do we observe these dynamics? Because when you have a credit register that is fully functional and accessible by lenders, these small loans, be it digital credit or microcredit, allow these borrowers to build credit history and facilitate their transition to commercial banks, which, as I mentioned, tend to offer larger, cheaper, and longer-term loans, and therefore can potentially lead to much larger transformative effects in an economy. So my suggestion here to Shumya will be to try to examine this interaction between digital and traditional bank credit more explicitly, including this transition of borrowers from big techs to traditional commercial banks. So this paper right now only has one chain, so essentially from cashless payments to digital credit, and I would like to observe the next chain of events, which is from digital credits to traditional bank credits, which I think is important. And there are many, many open questions here that could be analyzed. I will just leave them here to be considered. Just a minor comment on the instrument. So as Shumyao mentions in the paper, the bike adoption decision itself is endogenous, and this is very clear in this chart, that we can see that there is a pre-trend here. So in other words, the level of consumption is already increasing prior to the bike adoption, despite this sharp increase at t equal to 0. My question, and again, I buy the identification. This is just a minor quibble, but just my question here is just what factors could be driving this pre-trend that is very clear in this chart that the empirical model could potentially account for. And it's important to note that the exclusion restriction requires that bike placement affects credit provision only through the in-person cashless payment. So it will be good to understand what is driving this pre-trend. So overall, just to conclude, excellent paper. Just a few comments to better balance the narrative. So digital loans could be important to improve financial access, but at least for now, they might be far from a panacea. It's a very polished paper. It's clearly ready for the job market, but very difficult to discuss at my end. And I look forward to see it published and read any related follow-up work. Thank you.
Excellent, Andre. Before we open the floor for questions, apologies. If you don't mind, we go over around 5 more minutes, please. Would that be okay? Okay. So 5 more minutes. While we wait for any comments or questions from the audience or from the chat, let me give the floor to Shumiao to respond briefly to Andres' discussion. Shumiao, the floor is yours, please.
Thank you, and thank you, Andrew, for the great discussion, and all the points are well taken. And let me just quickly respond to some of the points. So the first thing is about the performance of the loans. So although I do not have the individual level default data, we do observe some aggregate numbers. For example, the delinquency rate of the Alipay's credit is like 1.2%. As of the late 2018, and during the same period, the delinquency rate of the credit cards provided by the public banks in China is between 1.4% to 2.1%. So although in some sense we regard the pool of the Alipay users tend to be less creditworthy than those who are the customers of the traditional banks, but they turned out to have lower delinquency rate. So somehow the Alipay do control the risk very well. But on the other hand, it's also can go back to one point that you mentioned. Perhaps it's because the credit is quite small, so it also lowers the delinquency rate. And also for the balance of the statement, that's definitely a great point, and I will highlight that actually there are some trade-offs. Although we can see an increase in the welfare, but we do see the increase in the default too, and that's something that we should talk about, because when you provide more credit, you definitely can potentially see there was some downside of that, and that's a really great point. For the pre-trend, I guess one thing that can explain the pre-trend is that the adoption of the digital wallet and the adoption of the bikes can be correlated. Like this can happen at the same time. So that's why we can see there was some pre-trend there. But if it's just a pre-trend, then we would be expect to see a very smoothly increasing pattern, but we do see some sharp change. So I hope that can kind of alleviate some of your concerns. Yeah, thank you.
Thank you very much, Miao. I think we have one question here on site. Please go ahead.
So this is a fantastic paper, really great paper. But my question is, it kind of like resonate of what Andre was saying, because we are actually seeing just like one provider and the effect of credit. My question is like. It really resonates what Andre is saying. My only thing is that the bike where the bike is like is going, it could be related to where the market, where like Allpay and the credit provider would like to go, right? So they are just like going there to get new clients and exactly the clients that they want. They want. And it could be that the other providers that you don't see, they don't want to focus on this specific market, right? So in the end, these guys would not really get credit from the other providers, but just the providers that really want to focus on this market, right? So do you have something about like how to control for the fact that Allpay and Hubei can all like go to the markets that they really want to provide both cashless credit and cashless payments and credit? But besides that, I really enjoyed the paper. Congratulations on the paper.
Shumyao,
Yes.
please go ahead.
Thank you very much for the great question. So definitely we might have some concerns that the placement of the bikes and the credit provision can be correlated. And in the paper, I actually have some tests showing that the placement of the bikes is more likely to be something exogenous to the residents. And actually, there were some reasons behind that, because there was some fierce competition in the bike sharing industries, and the people and different companies have different strategies. For example, some of them target the bigger cities, some of them target smaller cities to avoid the competition and so on. And also, these bike sharing companies are run by some third parties, not just by Alipay. So their main concern is about the competition, not just about how to promote Alipay. And you also raised a very important point about like this is just focusing on one product and whether there could be some externalities spill over, and also we might be wondering what's happening in the many other products. So I have 2 points. One is that this is the largest consumer finance product in China, and like one of the main competitor, WeChat Pay, does not offer similar virtual credit card product. So this is like the biggest. And also, I think the other point that I want to highlight is that I guess the story is kind of general for all kind of intensive margin settings. For example, if we look at a bank, a European bank or the US bank that offers some credit card to one customer. So if the consumer uses the debit card of this bank other than the other banks, then potentially this specific bank can provide better credit evaluation and provide more credit to these one specific customer and have some advantage over the other banks. So I hope I've answered your question. Thanks.
Thank you very much, Shumyao. Thank you very much, Andre.